Development Center. Today, we are going to discuss the Restaurant Revitalization Fund, What You Need to Know, led by Mary Beth Brooks, Director of the ASBTDC, and Scott Lacy, Business Consultant. We will be sharing a lot of detailed information on eligibility for the grant, calculations for the grant, the application process, and the documentation that you may need. Please understand that everything we are telling you today is based on what we have listened to and read. The SBA has not officially released any of their materials yet, but we expect that to come out very soon. We know that you will have questions. We want to answer as many as we can. So please engage with us via the chat and Q&A at any time during the presentation. We will be monitoring and answering them closely throughout the presentation and sharing them with our presenters. If we cannot see your full name in the participants, please send a message to panelists with your full name so we can link it to your registration, and be sure to follow up with a copy of the presentation. We will get to our presenters momentarily. First, I'd like to introduce us and tell you a little bit about ASBTDC. I'm Catherine Corley, a business consultant with the Small Business Center. And with us today, we have my fellow consultant and moderator, Amy Robinson. Please wave. Amy will also be monitoring your questions in the Q&A and chat. If you don't know about the Small Business Development Center, it's a one-stop shop for startups and existing small businesses. We're associated with University of Arkansas and affiliated with the SBA and statewide ASBTDC, as well as a national network of more than 1,000 small business centers. Locally, we offer complimentary one-on-one consulting that includes business and financial planning, marketing analysis, and more. We also offer programs covering relevant topics for business owners. And if you're not already a client, we encourage you to visit us at sbtdc.uark.edu. Click the Get Consultation button on the top right-hand corner to easily sign up. Please be advised that we are recording this webinar. You will be able to access this recording and the slides and much, much more via our website at sbtdc.uark.edu. We'll be posting links in the chat box, so make sure to watch out for those. And now I will turn it over to Scott.
Hey, good evening, everybody. Hope everyone's doing all right. Thanks for joining us tonight. Hope you had a good day at work and that everything went well for you. We're just going to dive in here for a minute. So on that first slide, about just kind of recapping the year for restaurants. It's been a tough year, to say the least. Restaurants in particular were hard hit. There were 110,000 food and beverage or eating and drinking establishments that were temporarily or permanently closed. We had nearly 2.5 million jobs erased and 240 billion in lost revenue. But thankfully, because of the Restaurant Association and some other affiliated groups talking to Congress on your behalf, there were some programs that were later rolled out that were targeted specifically for restaurants, one of which is the Restaurant Revitalization Fund, which we're going to be talking about today. But before we get into the Restaurant Revitalization Fund, I'm going to review the PPP, the ERTC, and the EIDL and how those programs are going to affect the Restaurant Revitalization Fund. So I'm just going to review those really quickly, and we'll start with the PPP on the next slide. So the Paycheck Protection Program was specifically to help employers keep employees, to protect their paychecks. It was good, but it wasn't necessarily the greatest thing for restaurants because of the way that the restaurant industry is structured with how it pays and how their employees are paid a little bit differently. But it did cover other things like rent, so it was good, but we wish it could have been better. And some of the larger corporations got to take a lot of that money up front in the very beginning. So the RRF, the Restaurant Revitalization Fund, is meant to address some of those issues specifically, and you're not going to be held to some of the same restrictions. So this will be a really good program for you. So if you're thinking, oh, this is just going to be another PPP program, I'm not going to get anything from it, that's not the case. This was really tailored specifically for the restaurants, and it's going to be a really good thing for you. It's not just another form of the PPP. Okay, so on to the next slide for the employee retention tax credit program that was rolled out. So originally this was created in tandem with the PPP, and it was meant to be an either or benefit for businesses out there. But after some feedback from business owners, the legislators, they rolled out different legislation that made it a little bit better, and they allowed you to be able to take both the PPP and the ERTC as long as you didn't double dip on the same expense. So that was a good thing. And that happened in December of 2020. And then to continue to improve it, the American Rescue Plan Act that came out in March extended the RTC through December 31st of 2021. So know that with the Restaurant Revitalization Fund, make sure you look back at the PPP, also look at this program, the ERTC, because some things have changed with it that's not necessarily going to affect this new program that we're going to talk about today. And also we wanted to mention that if you are looking at doing the employee retention tax credit, you've now got up to 18 months from the end of each quarter to refile or resubmit your Form 941. So if you look down at the bottom of that slide, take note of that. It's a really important piece of the ERTC that can benefit you. So you've got 18 months to refile your Form 941, which is how you take advantage of it in order to do that. And we would just encourage you to talk to your accountant as well on that one. And then finally, the EIDL, we had some really good news come out recently about that. The SBA raised the loan limit from $150,000 to $500,000, which is really good news for a lot of small businesses. And the way that you are able to access that program is the SBA is going to reach out to you directly via email. So you don't have to do anything. They're going to reach out to you. And that's really all you've got to do is just get them the information that they request through the email to you specifically. So it's the rate did stay the same. It's still 3.75. Other good news, they extended the deferment period. So that's when you have to make your first payment until 2022. So if you got your loan in 2021, that deferment period was extended up to 18 months. If you got, or 2020, up to 18 months. If you got it in 2021, it's been extended up to 24 months. But do keep in mind that as long as you've got that balance, that interest of 3.75% will continue to accrue. So that's the main point on the EIDL. So now onto the Restaurant Revitalization Fund. Why you guys are here? So when it was passed earlier this year, it created a $28.6 billion fund specifically to go directly to restaurants. It's called the Restaurant Revitalization Fund. If you Google it or search for it anywhere on the internet, it's specifically for you guys, and we can't stress that enough. Exactly what is a restaurant? We're going to get into that a little bit later because there are some different kinds of companies that are like restaurants but not exclusively restaurants. And so if you've got questions about that, I just want to let you know we are going to dive into that here in a little bit. They wanted to target this towards the smallest and most hard hit businesses. So it is targeted towards small restaurants. And in the first 21 days, the application period is actually they're going to only process applications for women, veteran, or minority owned businesses. And we're going to get into those definitions as well. It does exclude large chain restaurants, specifically if you're a publicly traded company or if you have a restaurant chain with a certain number of locations, you'll be excluded. But if you're a franchisee or if you're part of a franchise in some other capacity, there are other circumstances where you can still be eligible for this Restaurant Revitalization Fund grant. And I think I forgot to mention that this is not a loan program like the PPP or the IDL. This is a grant. It's just money to you that you don't have to worry about paying back. So I want to make sure that's really clear. It is going to be a first come, first serve program. So as indicated on the slide there, the appropriations will remain available until expended and they're tax free. So that's the other thing we want to mention is that this is not going to change anything about your taxes. This isn't going to be included on your gross receipts. It's not going to not allow you to deduct the expenses that you use this to pay for. You'll still be able to deduct those expenses on your taxes. So that's good news from a tax perspective. And you're not required to repay the funds. And the only real requirement is that you have to spend everything by the end or by the end of the period, which is March 11th. And they just recently extended this last week all the way until 2023. So you may see on the internet that it's sooner than that, but just very recently they went ahead and exercised their authority to extend this program as far as they could, all the way out to March 11th of 2023. So that's really good news.
Hey, Scott, one point I think is really interesting on that slide is when you say on here that there's almost $29 billion available. I think that's amazing. But at the same time, when you look at how many restaurants applied for PPP1 and PPP2, and somewhere I read recently that was like $72 billion that the restaurant industry received in PPP loans. That tells you that really the 28.6 isn't as much as I wished it would be.
Correct. I'm glad you reminded me about that. I had it in my notes and forgot to bring it up. So they are, everybody wishes there was more money for sure. And the sort of in confidential meetings, I guess you could call them, people have unofficially and on the record said this is more than likely going to run out and run out fairly quickly. So get on board as soon as you can. And hopefully when we see the money running out, they'll be able to pass another round, but that's not anything that we can count on. So do keep that in mind, that you want to apply as quickly as possible, because there's probably, unfortunately, not going to be enough to go around. Okay, so next slide. So just a quick note on certification. As far as qualifying for this program, just like with the PPP and other programs, you will be asked to self-certify or basically swear that due to the current economic uncertainty, that this funding request is necessary to support your business. And in our discussions with the SBA and the webinars that we've attended with the SBA as part of the training for all these kinds of things, they have indicated to us very clearly that basically everyone can check this box with a clear conscience and not have to worry about it. So there's no other regulations there that you need to worry about. Just understand that when you do check that box, this is what it's referring to, especially since we are still undergoing the effects of, or still experiencing the effects of the pandemic. Okay, so I want to get to the covered period for the grant program again. It's on the next slide. So again, like I mentioned before, it has been extended through March 11th of 2023. That is correct, 2023. So it's a good thing. Originally, it was earlier than that, but they did extend it. So you've got until March 11th of 2023 to spend the grant money on eligible expenses. And those eligible expenses we'll get into here in just a little bit. Okay, so how do I know if I'm eligible is on the next slide. So there were some specific businesses listed. We think about restaurants sort of in a broad sense. That does include all of the establishment types that are listed here on this slide. So food trucks do count, caterers do count, even taverns do count, tasting rooms, bars, those kinds of things that you might not necessarily think about as a restaurant, but they still are food and beverage based businesses is what you can think of it as. Now, there are a little bit more strict requirements specifically on what you've got to do to qualify for this. And that we're going to get into again here in just a little bit, but basically they want 33% of your business to be on-site purchases or on-site, come in, sit down, eat, drink on site. So that number is 33% that they're looking for. So if you're not exclusively a restaurant, if you're something else like a bakery that also sells like, lunch, they're going to want 33% of your revenues at least to be coming from, your non-wholesale, non-outside of your business to be able to qualify. So just to make the eligibility requirements real simple for you, we put three things together on the next slide. Just to keep this in your mind, you've got to be a business, so not a nonprofit. If you're a nonprofit, unfortunately, you don't qualify. You've got to be a business where you have people publicly assemble that you finally serve food and drink on your premises. So really simple. You're a for-profit business where people come and gather to eat and drink on your premises with a minimum of 33% of your revenue. And just to clarify a little bit further with some examples on the next slide. So here's just 4 examples for you. If you're a bakery, your on-site sales to the public need to comprise at least 33% of your gross receipts. The same goes for brew pubs, tasting rooms, wineries, distilleries, or inns. So that 33% number is what you're looking for. And they're going to determine that based on documentation that you provide that we're still trying to get a little bit of clarification on, but we do have some examples for you.
Hey, Scott, we have a question from the audience. Can you elaborate on the definition of caterer? And I know we had some examples last time of a venue that does catering versus a caterer, so that 33% becomes real important. Can you talk about that distinction, please?
Yeah, so I'm actually not super familiar with it, but we have been told that you will qualify, and as long as your is 33% of your business is where people are coming together to be able to eat the food and the drink that you serve, and you don't have, like, for instance, if you're doing your catering and you have a food prep kitchen and you do all your food prep there, and you do your catering, but then you also have like a wholesale food prep business that you sell out to, let's say, but it's all prepped in the same kitchen. You need to have at least 33% of your catering stuff, because that is considered where people are coming to sit down and eat your food, and not necessarily outside non-on-site dining wholesale. You would still qualify, as I understand it, and some of the rest of our team might be able to clarify a little bit better than me, but that is the way that I've understood it so far. Okay.
I'll echo that a little bit, Catherine, on your question. They have not gone into as much detail yet on caterers, but because everything I've seen so far has not been as specific on the 33% as it is on bakeries and brew pubs and tasting rooms and those kind of things. But I know caterers are a part of this. But I will also say I've received several questions about event venues. So if it's an event venue and someone caters in the food, if you're the catering company, that's eligible. But if you're the event venue, you're not. It's not.
Yeah, and sometimes it helps to clarify it in order to show who specifically doesn't qualify, and that's what we've got on our next slide, if that's going to be helpful. So here's a list of people who do not qualify that we're going to pull up. So if you're a state or government or local government business, you don't qualify. If you have more than 20 locations, except in some franchise circumstances, which we're going to get into a little bit later, you don't qualify. But basically, they're just trying to keep out the big publicly traded businesses there. But if you happen to be an owner with more than 20 locations, get in touch with us and we'll work through that with you. If you're a franchise, if you're not a franchise, you won't qualify. If you've got a pending application for the Shuttered Venue Operators Grant, you won't qualify. If you're publicly traded, if you've already permanently closed, unfortunately, you can't go back and retroactively do this. If you're a nonprofit that also does like on-site food sales, unfortunately, you won't qualify because you're organized as a nonprofit. This was also not a strange thing. I kind of understand it, but something interesting that did pop up. You do need to be eligible for at least $1,000. So when you apply and we go through the formula for how much you're eligible for, you need to be eligible for at least $1,000 to qualify for this program. But I think everybody here will probably do so. You also can't be listed on the Treasury's Do Not Pay list, on the Office of Foreign Asset Control list, or the OFAC sanction list, or the death records list. So, kind of funny there, but they do want you to be alive. The entity, so you can't have filed for bankruptcy under Chapter 7 or be liquidating under Chapter 11. And you also don't qualify if you have filed under Chapter 11, 12, or 13 without an approved plan for reorganization. So again, kind of technical there, but get in touch with us and we'll walk you through it. So that's sort of what we got on eligibility. And with PPP and EIDL and ERTC, there were always these questions about, affiliation, and I've got this many locations, or I've got a management company that manages multiple locations. What exactly is an affiliation? So first, I want to clarify that the definition for this program of what an affiliated business is different than what it was for PPP. So I want to be real clear about that. If you know the requirements for what an affiliated business is under PPP, they have changed for the Restaurant Revitalization Fund, and they're operating under a different definition specifically for this program. And here they've defined it with 2 requirements. An affiliated business is a business that, one, is itself an eligible entity that has equity or right to profits or distributions of not less than 50%. So in other words, if you own more than 50% of multiple companies, or if you've got a right to the profits, not less than 50% of the RRF, then you're considered an affiliate. And the second one is if you've got contractual authority. So the first is like they're saying, hey, if you've got financial control of multiple companies, then they're considered affiliation. Then they're considered affiliated. But if you don't have financial control and you only have contractual control, then you're still considered an affiliate. So those are the 2 definitions of how they're going to use affiliation on this one specifically. All right. So just real simple there for that slide for you guys watching the recording or seeing it now on how they're defining affiliation. So common ownership more than 50% or common management. Okay. Now the next slide is going to address franchises, which we've mentioned already before. And this is how they're discussing franchises, and we're going to clarify them here. So they're considering a franchise any business operating as a franchise who meets all other program requirements is eligible. Let me read that again. So any business operating as a franchise who meets all other program requirements is eligible. So just because you've got, a ton of locations, you might still be eligible. Even if your franchise is publicly traded, you could still be eligible as long as you otherwise qualify and a publicly traded company, and the publicly traded company is not an affiliated business. So a little bit of legal jargon there for you guys, but hopefully that clarifies exactly what we're meaning by franchise. And again, if you've got specific questions, if you're involved in a franchise, we'd love to talk to you about that. The other requirement is how you're legally organized, which is on the next slide. You do need to be organized as one of these specific entities in order to be able to qualify. So C Corp, S Corp, partnership, LLC, sole proprietor, self-employed, independent contractor, or tribal business. These are the ones that are eligible, and you need to be organized as one in order to qualify. So that's all I've got. I'd love to answer some questions for you guys at the end, but until then, Mary Beth has got some more information to present to you about how much you're going to qualify for and how to, be able to provide documentation and those kinds of things. So, Mary Beth.
Great. I know everybody's really wanting just to know more than anything, how much do I get? I am in desperate need. So the grant, they have done a really good job of keeping it pretty simple. The grant is equal to your pandemic related revenue drop. So if you had about $1 million in gross receipts in 2019, and if the pandemic hit you pretty hard and you only had 600,000 in 2020, you could be eligible for a 400,000 difference as a grant. It's really a program designed for you guys just to make sure that it's trying to get you whole again. And I'm super excited about it. Not sure if there's not enough money, but I'm really glad that at least you'll have this option. The maximum amount for an affiliated group is $5 million per location for a maximum total of $10 million. So if you have 20 locations, you're going to divide it up. Also, the grant is reduced by any PPP funds you've taken in 2020 or in 2021. So to go back, furthering an example, if you had $1 million drop in gross revenues. So if you had $2 million in 2019 and $1 million in 2020, therefore you have $1 million drop in gross revenues. And if you then took $500,000 in PPP loans, the grant then would be reduced to $500,000. Other things just to make sure to note on this slide is when you're calculating your gross receipts, because everything's based on gross receipts, you do not include, that was a big question early on in some of the other programs, do not include PPP loans or any idle loans or any local loans or grants or anything like that. You don't include any of that in your gross receipts. It's truly going to be receipts from your sales. Also, when I was mentioning you're going to subtract out the PPP loans you received, that's the only type of loans or grants that you're going to subtract out. If you if you received anything locally or from the state or from other programs, the only ones that are going to be deducted are going to be your PPP loans. So let's go on to the next slide. And we'll go into a little bit more detail on that. I really have some examples at the end of the presentation too that I think will help you kind of go through to understand it earlier. But as we mentioned earlier, the calculation for a restaurant, because I'm impressed that they specifically called out if you were open prior to 2019, if you opened in 2019, or if you opened in 2020. So they've closed the gap in helping us answer a lot of those questions with this program. So if you, let me see how to best say this. If you opened prior to 2019, you take your 2019 gross receipts, less your 2020 gross receipts, and then you just subtract out PPP1 and subtract out PPP2. Really pretty simple. So for you guys who opened prior to 19, it's an easier calculation. For a restaurant who started during 2019, you take your average 2019 monthly gross receipts, multiply it by 12, subtract out your 2020 gross receipts, and then subtract out your PPP loans, and that should be your grant amount. And then for restaurants that opened between January 1 of 2020 and March 10th of 2021, and then also applicants who have not even opened their restaurant doors yet, but they have incurred a lot of expenses, the calculation is going to be that you take all of those expenses and then you subtract your 2020 gross receipts minus any PPP loans. Let's go on to the next slide, and hopefully some of these examples will clarify everything. So for just a small restaurant, let's say you have 600,000 in gross receipts in 2019, and then your 2020 receipts were down to 200,000 because you were closed and you also had reduced capacity. So this $400,000 drop in revenue would be the grant you would be eligible for if you did not receive a PPP loan. So the next slide is going to be a little bit larger of a restaurant example. And don't laugh when you see my location names. I called them A, B, and C, very creative. For each one. So you're going to go through and calculate for each particular location. So let's say location A had a $6 million drop. And therefore, if you had a $6 million drop, therefore the eligible maximum loan that you can receive is $5 million. Location B had a $3 million drop. And then therefore they would be eligible for $3 million. Then location C of the same restaurant had a $6 million drop, but then they would only be eligible for $2 million since the maximum for the entire organization is $10 million. So then the next slide is going to show how the PPP loans work with that. So if you did take PPP funds, you just have to reduce that grant by the PPP amounts. So in the earlier example, if you had $600,000 in receipts in 2019, and then $200,000 in 2020, that was a $400,000 drop in revenue. And in this example, let's say you also had $100,000 in combined PPP1 plus PPP2 loans, you would then be eligible for a $300,000 grant. So hopefully that'll give you at least some kind of good example. So I know one big question is, how do I apply? And I know one of your even bigger questions is, when do I apply? So that is, we can't answer that question yet. We're not sure, but at least we're just trying to give you this information preliminarily so that you can be prepared. We just want people to be, assembling all of your information and be ready to submit. So the most recent information I have is that you're going to apply. We know you're going to apply directly through the SBA, but your bank is not going to be involved. It's going to be directly through the SBA. Who knows, it might change. We'll continue to keep you updated. Restaurants.sba.gov is the last that we had heard. The SBA and others are going to release a lot of guidance in the next few weeks that's going to provide you more clarity. If you read all sorts of things with what's going on in Congress, they're really trying their hardest to get this open by the end of April. But I think they have until like 60 days from that March 11 date. So that would be May 10, 11, somewhere in there. So in the next 2 or 3 weeks, hopefully you'll be seeing a lot more information on this. And again, we'll be happy to answer any questions. We might even do this again to cover cover more information for you. But I do know that they're going to allow, if you go back to that previous slide for me. Thank you. I do know they're going to allow some POS, some point of sale vendors to help with the applications as well, which is going to be great. I know that the ones that I've heard discussed are Toast and Square and Clover, so that then if you can do that through them, because they obviously already have a database of all of your sales information, that could really be helpful. Even if they don't, even if you don't maybe necessarily use that particular POS, one of those particular systems, you'll still be able to use your POS system reporting and then be able to upload that information. Also, what I've heard is that they're going to try to even have some kind of telephone type application tool, because we have a lot of restaurants that maybe don't necessarily have the world's best Wi-Fi capabilities. So that supposedly is going to be a solution as well. I really think that they're working their hardest to make this this application process timely and good for restaurants throughout the country. So then let's go on to documentation. And I realize this is the really boring kind of information, but we've got to go through it. I won't read it to you. You can get copies of the slides and have that information, but we have to discuss what all they're going to want. Remember that you're going to be uploading the documentation into a portal. So start getting it all together to where it'll be really easy for you to submit. Items that obviously are going to be included are going to be the regular application, and you'll just sign it digitally. The IRS form 4506T, it pretty much just provides validation of income. And then the typical things that most of you have probably submitted what you feel like 10 times in the last year: tax returns, internal profit and loss statements, bank statements, your point of sale reports, including the 1099K. And again, I mentioned earlier that some of the POS vendors are going to be able to submit some of this for you. Let's go on to the next one, because they're going to be even additional documentation that's going to be required for some. So there are really more specific rules for brew pubs and tasting rooms and tap rooms, breweries, wineries, all the really fun places to be, the distilleries, the bakeries. And I know that Scott made mention of this, but this confirms it, that you're going to remember that this whole entire application is for places that have the ability, or that provide the ability for people to gather, to eat, or to drink, and they're paying for it. So you will have to provide documentation that on-site sales add up to at least 33% of your gross receipts for 2019. That's just 2019. Maybe you could use the Tax and Trade Bureau report. Maybe that could help. I know that I've already visited with some who are concerned about this, because maybe they don't have, some less sophisticated restaurants maybe don't have that, they haven't separated that out. But from everything I can tell, you're going to have to be able to prove that 33% of your gross receipts for these particular these specific businesses are going to require that you prove that revenue split is 33% at least from on-site sales to the public. So next, we'll just go to the last, yes, this documentation slide. I'm really happy that they did this, because I actually have several clients who are going to fall right in these dates. If you began operations between January 1 of 2020 and all the way up to last month, as well as any applicants who maybe haven't even opened their doors yet, you are actually still eligible. The calculation is going to be a little bit different, but you will have to supply documentation, because remember we discussed that you're going to look at your eligible expenses, and you're going to subtract out any gross receipts you have. So you're going to have to be able to provide information on those eligible expenses. And I don't think yesterday in this, when we did a webinar like this, I didn't explain enough on eligible expenses there. The same expenses that are eligible expenses for how you're going to spend the money are going to be the same eligible expenses here. But I'm sure the SBA is going to provide more information on this, and they're going to go elaborate more so that we'll have a better idea. But it's really good news that those folks are going to be able to benefit from this grant. So start compiling all that information now. Let's now go into some priority groups. Scott alluded to this earlier. The initial 21 days, the SBA will prioritize certain businesses that are owned by women, veterans, and socially and economically disadvantaged groups. It's mostly targeted toward different minority groups. They give a broad definition of what that means, but in a sense, if you're an individual who historically has faced some social prejudice or economic disadvantages, you'd most likely fall into that group. On the 51% requirement that you see there on the top, they're flexible to reflect so many different ownership structures within a restaurant. So if you have 3 people who own it, one of them is a veteran, one of them is a Black man, one is a white man. Between the veteran and the Black man, if they each own 33%, that adds up to over 51%. So they should be able to qualify in that particular capacity. But you will have to certify. And so you have to be really honest and so if it's a 50-50 deal, that if it's a husband and wife who own it and they originally did it, I mean, they have it as established as a 50% him and 50% her, then that's not going to be, it's not going to meet the definition here of the 51% female owned. So let's go on to discuss the set asides. Next slide, please. The first $5 billion is going to be set aside for entities with gross receipts of $500,000 or less. And then another $4 billion is for 2019 receipts from $500,000 to $1.5 million. And then another $500 million is set aside for those applicants that are really small, that have receipts of not more than $50,000. So I kind of brought this up a little bit earlier, that 28.6 billion, it seems like a lot of money, but the SBA anticipates that it's not going to be enough to meet the demands that are estimated to be well over $100 billion. So I think this process might be like how it happened with PPP. Anybody who went through the PPP1 process remembers people were flooding in their applications, and then that funding ran out of money. I think that could be the same case here, and they'll have to go back to ask Congress to allocate more money. So, I mean, from these calculations that I show on this slide, I mean, if you have $9.5 billion of that 28.6, so think about 10 out of the 29 billion is for restaurants under the $1.5 million in 2019 receipts. You can really tell that they're focused on small restaurants. So let's talk about the timeline. Let's go to the next slide. Notice here, I don't have a date of when it opens, so don't ask me. I'm not sure. I can't tell you. I don't know. They're working on the portal and working on final understanding to where they can get everything out to potential applicants. So it will come all in due time, but our goal here is to help you be prepared. So the first 7 days are going to be a pilot period for self-certified applicants who meet the requirements that we were just discussing, the women, the veteran, or socially or economically disadvantaged. This is just going to be a few thousand applicants, and it's a pretty smart way to do it. They're just going to do it to then make sure that the system is ready for the broader population. So for anybody who knows folks who have a shuttered venue, so anybody who has like live performing arts, they were all applying on April 8th for the shuttered venue grant, and the SBA website crashed within a few hours of it opening. So I feel like this was really, they are anticipating that. They want to make sure everything's ready to go for you guys so that it will go smoothly. So that's how it's going to be for days 1 through 7. Days 8 through 21, anyone can apply, but those are the days that it's going to be reserved for those particular groups that I mentioned earlier. They're just going to they're doing this to make sure that the funds are available for that particular group. They will not fund any applicants that are not already in that category, but you can go ahead and apply. So if I did not fall into that category, I would still want all of my data, everything uploaded, and my application finalized day 8 to then make sure, even if I can't be funded until after day 22, I want to make sure everything is in there. So days 22 through the time when they run out of money, all applicants can apply, and the SBA will award funds in the order that they were received. I think Scott mentioned that earlier. So next slide, please. I really wanted to give you the definitions of the different priority groups. I'm certainly not going to read them, but you can, if you get these slides, you can then see how it is that they are going to better define socially disadvantaged and economically disadvantaged individuals. but I want to make sure we stay timely on this call today. So if you have
Hey,
any
Mary
questions.
Beth,
Yes,
yeah,
ma'am.
there is one question. So, say a husband and wife have ownership. And let's say they have 40% ownership of the business. Is it soon to be 2020? And what if they want to shift that in order to be able to be eligible for majority owned by a diverse business? What is there? Do they need to change things? Can they do that?
Well, I don't see anywhere where they can't do that. I mean, they're going to have to self-certify that they are. But I guess if they wanted to shift it, if my husband and I own something 50-50, which I work with so many businesses that are owned that way, then I guess there's nothing to stop me from shifting it. I haven't seen anything yet that says to the contrary. But because you're going to self-certify it, and from looking at any of the preliminary applications that I've just dug through all the congressional information, it looks to me like it's a self-certification that says pretty much as of the day of the application, this is the way our business is set up. So yeah, I guess that could be a possibility.
And I think you kind of stated this in your example, but let's say you've got a married couple that has half of it's female, and then another female owns the other percent. As long as the female adds up to over 51%, then
Right.
it's considered a female owned, even if
Yeah,
there's
so
other.
I guess you could look at it as if there are two couples that own a business, and it's male female couples in each one. If you want to do a male female couple, then a lot of them are going to be established to where, one couple owns 50 and one couple owns 50, or each person owns 25. But if that were instead, a 30-20 and a 30-20, then it meets, and the 30s are the females, then that would meet that requirement.
Great, thank you.
Mm-hmm. And again, I guess I should preface all that with, that is my understanding, right? As of today, that is my understanding. Let's go on to the next one, and we're going to talk about once you get your money. So remember, it's going to be directly deposited into the account that you list on your application. Now, how can you use that money? So it's pretty similar to the PPP funds, but with some really positive differences for you guys. Again, you can't just go out and take a big trip. So you have to use the funds on allowable expenses, but they continue to give you more flexibility than each of the previous programs. As Scott mentioned earlier, the covered period, where the funds have to be used between February 15th of 2020 and March 11, 2023, which is pretty remarkable. I mean, considering that it's the middle of April, and if you get this money the middle of May, that means you have 22 months in which to use it looking forward, but you can also go back. So that I think that gives you plenty of time in which to use this money appropriately using the allowable expenses. And as long as you can show that you have spent that money on eligible expenses, you can exhaust all of those funds, and then you can get it. I mean, then it's automatically then forgiven. So remember, there's not going to be any kind of forgiveness process like there was. This is truly a grant, but you still have to be able to use this money on allowable expenses. But then there's also the caveat of, if you do not utilize all of the funds by the end of the covered period, you must return them. So let's go on and look at those allowable expenses. So again, you have to use your expenses during the covered period. The eligible expenses, you can read the list. I'm not going to read it for you, but you can. The key is, I think most of them are really straightforward, but a few things I wanted to highlight. So on payroll, you can include the sick leave, and really you can include, the typical things that you could include before with PPP. But remember, just like PPP, you're going to have the $100,000 cap per individual. This is awesome that it's principal and interest on any business mortgage obligation, but you cannot prepay it. But again, that's better than PPP. So very much improvement there. You can even pay business credit card debt. You can pay 7A and I mean, like the SBA 7A and 504 loans. So anything that's affiliated with the business on credit cards you can pay. You certainly couldn't do that with any of the previous programs. Utilities. So they've got more broad definitions now that's going to allow you, I feel like, a better options of how you're going to pay these things. You can include cost of goods sold with food and bev. You can, your business operating expenses. I mean, that includes just, wow, about any business, insurance and marketing expenses and point of sale equipment and licensing and depreciation. I mean, it's like a non-ending list. Maintenance expenses include cost to add another new patio and your furniture that you put out on the patio, and then even your space heaters for the fall and the spring. And so you can, there are a lot of options for you on those allowable expenses. I think the alcohol supplies is what I've heard the most rumblings about on trying to get those added, but they are not as of yet. But that maybe is in the works prior to the final rules coming out. And then the other key is that, remember, for PPP, when you had to have the 60% had to be spent on payroll, no such rule here. There is no 60-40 split. So you're not required to do anything on payroll.
Hey, Mary Beth, before we go on, again, I think there's a lot of excitement over, principal and interest and debt service. The question keeps coming back around to prepayment. You can't prepay it. You can pay your monthly, but you also have until March 2023.
And I understand, because if I'm in your shoes, and I own a restaurant, then I'm wishing that I could go ahead and get all of that money expended, so that I don't have to worry about it and I don't have to track it and I don't have to, get my big Excel spreadsheet to make sure I'm doing it in case I get audited. But you're just going to have to be patient. You really and truly can't prepay. But my goodness, if you can pay 2 years worth of your of those same mortgage payments or those rent payments, and you can include your payroll, you can pay, you have that mile long list, then instead of prepaying, just be patient and do it the way it's supposed to be. Follow I'm pretty much a rule follower, so I would certainly follow the letter of the rules. So let's go on. I'm on the next few slides. I'm going to try to explain how all of these different programs interact. Because it's really important in order to get the most benefit from any of these programs that you understand how they interact. So PPP loans obviously are going to be subtracted from your restaurant revitalization fund, the funding calculation. And then, just in case for anybody maybe who is just now applying for PPP2, I don't know many, since a lot of the banks are no longer taking them, but the applications are still open at a lot of places. In case there are any outstanding PPP applications out there that are in process, the SBA, their plan is just to decline them, and therefore it's not going to be subtracted from your amount. So that should all work out fine. They already have a plan for that. Again, we said earlier, you cannot have already applied, or hopefully that process is opening up soon for the SVOG grant. You can't do both. It's either or. And then Scott brought up the employee retention tax credit also. Just as a reminder, it's a really good third option for you for 2020 and 2021. They've extended it now all the way out to 2021. But let me tell you, from looking at all these different programs, this is where excellent record keeping is just, it's paramount. You have to be able to do that. And I think that everybody learned that with PPP. But as you were trying to figure out, you're going to have to be able to go through and say, I got my PPP loan. I use these particular expenses in order to get that forgiven. Therefore, I cannot double dip and use those same expenses, these same payroll expenses for the employee retention tax credit. So it is going to require some great work with your CPA and some great work with you. Your CPA can't do it all, but to where you're really staying on top of those. Let me just give you an example. I think that should make it easier. So if you're using your payroll, in Q1 for PPP2 forgiveness. So you got your payroll, you got your PPP2 loan in January, and you're going to use your January, February, March payroll in order to get that PPP2 loan forgiven. And then let's say your payroll is being used in Q2, Q3, and Q4 of 2021 for the employee retention tax credit. From everything I have read so far, you cannot use those same expenses as allowable expenses for the Restaurant Revitalization Fund. But again, you now have all the way until March of 2023 to use the Restaurant Revitalization Fund money. So there really should be no reason in the world to double dip. So let's go on to the next one. I'm going to try to go through a little bit more on how these interact. Comparison of expenses for you. A lot of the expenses, obviously, like I said earlier, are going to look really familiar. Any expenses you could use for PPP, you can use for the RRF. And since the covered period is so much longer, you could really look outside of that same period. Several expenses are not included in PPP that are in RRF, like I mentioned. Those maintenance expenses, and now they completely call out that you can use cost of goods here for RRF. The operational expenses bucket, I just think is just, it makes me laugh because really everything in my mind is an operational expense in the restaurant business. So much could really fall into that bucket. Let's go on to the next one. Next slide, please. There. And I mean, again, the RRF is so much more generous in allowing certain expenses. But to continue the comparison, remember that neither PPP nor the Restaurant Revitalization Fund has to be paid back as long as you use them for allowable expenses. But for both PPP and RRF, the expenses are tax deductible, which is exactly like what Scott was mentioning earlier. And the money that you get in is non-taxable income. Huge. And they're reminding you of that from the very beginning. On the Restaurant Revitalization Fund, again, no 60-40 split required, like in the PPP, when you have to spend 60% of your funds on payroll. And also the good news is on the RRF, again, no loan forgiveness processing and no calculating FTEs, which I think makes everybody pretty happy. So let's go on to the next one, and I will quit comparing these. But if you're not aware of the employee retention tax credit, we keep pushing it with so many of our clients. Get with your CPA. This is such an important. I mean, you could just be. It's sometimes it's a little bit more of the free money. So, but again, it requires really good tracking. The Restaurant Revitalization Fund is for payroll and non-payroll costs. When the employee retention tax credit is just for it's just a credit on your payroll. But I feel like, and this is again, just from what it's worth for me, I feel like that the RRF really needs to be prioritized because it's a true dollar for dollar grant. On the employee retention credit, you get a 50% credit for 2020 expenses and a 70% credit for 2021, which is pretty remarkable, but still at least the RRF, I feel like should be prioritized. Deductions for the RRF are still deductible and the grant is non-taxable. In comparison for the employee retention credit, you're reducing expenses. So that really in effect is increasing taxes. Disadvantage, I guess, of the RRF is there's such a short window to apply for it. And there are really limited funds out there for it. And in comparison to the employee retention tax credit, heck, those funds, there's no limit to it, but also you're allowed to go back and file amended 941s and much later. So, I would look at it as a big picture with your CPA and put it all together to where you can figure out how to best maximize all of those benefits. Next slide, and we're going to talk about maximizing those benefits. I think the gist of this is that if you look, I feel like the Restaurant Revitalization Fund, I mean, it's such a great grant, but I would try personally to push more non-payroll expenses to that grant program, since so many other programs are revolved around payroll. So if I could do, kind of focus all payroll on the people, I'm trying to make sure you get everything forgiven on PPP1, PPP2, and then employee retention tax credit. The employee retention tax credit ends at the end of 2021. So if you could push more of the true non-payroll expenses to the RRF, I think that would be a really good idea. So no matter what, go to your CPA, get with your CPA and make sure that that you're getting everything you possibly can to maximize the benefits from these great programs. We compiled a list. We've been getting so many questions that we just compiled a list of a lot of our frequently asked questions. So Scott, how about if you'll take over these next few on these that we've prepared?
Yeah, sure thing. That was a lot of information. I was muted. Sorry about that. I hope that was clear for you guys. It was a lot of information presented really well, I think, though. So first question is, what if I started a business in 2019? So as you heard Mary Beth explain, the calculation is, you subtract your loss, 2019 over 2020, you get the difference, and they're trying to go there. But the question is, what if I wasn't in business for all of 2019? What if I was only in business for, a month or 2 or 6 months in 2019? So we put this example together here in the slide that we're going to go over real quick. So you compare your average monthly annualized gross receipts from 2019 to 2020. But for example, if you opened in July of 2019 and your average monthly gross receipts from July to December were $100,000. So to annualize that, you've got 100,000, because those are your sales, times 12. So that's 1.2 million. That's what when you annualize it. So that would be your 2019 equivalent. But then in 2020, your restaurant is open the whole year, and your sales were 500,000, for the whole year. So your eligible revenue loss would be 700,000, or 1.2 million minus the 500,000, like Mary Beth went over before. So they've given you a way to be able to calculate your losses, equitably, even if you weren't open in all of 2019. They're giving you the benefit of the doubt there, basically, and being really generous, just assuming that you were going to be open all of 2019, even at a level that you had just opened at, which is a really good thing. So the next question we get is, what if I started a business in 2020, which is on the next slide? So you just compare your gross receipts for 2020 to your allowable expenses. So if a business started in February in 2020, had total qualified expenditures of 700,000 and gross receipts of 500,000, then you're eligible for the difference, which is $200,000. So if you'd like to go over those calculations with us, we're more than happy to. So the next question we get a lot is, how is this going to impact my tax return? Because obviously, under some scenarios, in the past, this may have been considered part of your gross receipts, or because it's a grant, you may not have been able to deduct these expenses. But good news is all of those things were taken care of through the legislation. It's good news for you. It's not going to affect your gross receipts, which is not going to affect your total taxes, and you're still going to be able to deduct these expenses that you use this money for from your taxes at the end of the year. So it's not going to have a huge negative impact on you as we thought it might for something like the PPP last year. All of those things have been taken care of, and it's really good news for you. Let me make sure I'm hitting that last point. Yeah, okay, there we go. So another question we get a lot is, how does the SBA calculate gross receipts? And here's the definition for you here. It's all the revenue in whatever form received or accrued from any source, including the sales of products or services, interest, dividends, rents, royalties, fees, or commissions, reduced or returns and allowances. But the good news is here, the big thing to know is that you don't have to include the PPP in your gross receipts. They've already accounted for the PPP by subtracting it from your total eligibility amount. So there were some questions about that with other programs earlier in the year. That's now been taken care of through the other legislation. You don't have to include it in your gross receipts because it's already taken into account. You also don't have to include capital gains or losses, and they don't include your sales tax. So that's another one that sometimes people forget, especially that use programs like Square or other POS systems. You just see that total at the bottom, but don't forget that total at the bottom sometimes includes the amount of sales tax that you've collected. So make sure when you're going and you're doing your numbers, you're taking that sales tax back out of your total, gross receipts or your total cash collected or total other forms of payment collected. So when does an eligible entity have to have been established to receive the RRF grant? This is other really good news. Unlike the PPP, you don't have to have been in business by a certain time. You just have to, if you get the money, you just have to spend it by a certain time. So even if you're not open yet, but you're just currently under construction, you still qualify. So there's no requirement for an entity to have been open before a particular date. If you weren't open before January 2020, you're still eligible. And again, they made a specific calculation just for you, which is eligible expenses incurred minus gross receipts minus PPP loans equals the grant amount that you are eligible for. The next question that we get a lot is, can a nonprofit organization which owns an eligible entity apply? Unfortunately, right now they've drawn a hard line for nonprofits that if you're a nonprofit, you do not qualify. They could release, the way these things usually work is they prepare the programs and then they release, lots of pages of guidance that we will then read through for you to help clarify some of these questions. But that guidance hasn't been released yet. This is all initial stuff that we're just trying to get out to you as soon as we possibly can. So this might have some more nuance to it, but right now it's a really clear black and white. If you're a nonprofit, you're not eligible, unfortunately. Next question, you may have heard that you needed a DUNS number or a SAM.gov number, and that process took a couple of weeks and was kind of difficult to get through. Great news, you no longer have to do that. So several people tried to do that, and we just got a lot of feedback, or not us, but the SBA got a lot of feedback, but it just wasn't going well, so they did away with it. You don't have to do that anymore, but if you've already got it, that's great. Now you've got it, but it's not going to affect your application or be required for your application, and that just happened on March 30th. So those are all the FAQs. Mary Beth's got some more stuff to cover, and she'll start with that other stuff there.
Yeah, I just added a few last minute because I can't continue to get a lot of questions from folks. So hopefully these can help you out. Just first of all, quick reminder, like 1 million restaurants are eligible evidently to apply for this. So you can do the math when you have almost 29 million. That doesn't add up well. So therefore, just make sure you have everything ready to go on your applications. But I think also Congress realizes they're going to have to put more money in it, but I would never assume that they are going to. So just get everything ready. So just some other general reminders, banks and CDFIs are not going to be involved. It's all through the SBA. I talked about you're going to receive your grant through a direct deposit. You may have to provide ownership info for owners over 20%. So just have that ready just in case. Yeah, Scott just went through a couple of these on PPP loans and such. Let's go to the next one because I want to make sure we have time for any other Q&A. More of the same. You can't prepay your rent, can't prepay your mortgage. You have to return any money if you do not spend it by the end of the covered period, or if the business is closed. Food and beverage expenses, eligible expenses include cost of goods. And I talked about that the alcohol is a hope, but I'm sure the SBA will clarify that. If you put eligible expenses on your business credit card, you can pay on that credit card with these funds, but only on your business credit cards. Please don't try to do that on your personal ones. So even some questions came up in the last couple of days since I was working on these last slides. You do not have to be a certified women-owned business. So you don't have to have gone through that process, but you are going to have to certify that at least 51% of your ownership is the female, veteran, and socially and economically disadvantaged, like we discussed. There's not a requirement to spend 60% on your payroll. We have had several questions on how to apply. So a lot of this is going to be like it was with PPP. Remember the aggregate rules of the 10 million max. But if they're all set up as different LLCs and separate EINs, you're most likely going to have separate applications, just like you did with the PPP. There was some wording in the legislation that the SBA could carve out in certain regions of the country. I'm not sure how that's going to end up looking, but just to let you know of that. And then I have had a lot of questions of what if I was forced to close my restaurant in 2020, but maybe not permanently, but just temporarily. Nothing really precludes you from applying as long as you are going to reopen, because you are going to have to certify in that respect. But I'm also, since they're going to be allowed to prioritize certain businesses, I'm not sure if they're going to take that into consideration. And then audits, I've had a lot of question on that, since everybody now is realizing, wait, there's not going to be a forgiveness process. Who's going to check up on me? somebody's going to, or somebody will check out there. I don't know if they're going to spot check. I don't know if they'll do them for over a certain amount, but I certainly would make sure that I was tracking and tagging all my qualified expenses and I was ready for that audit in case that anyone knocked on my door. That's all I have. And make sure that Scott, you can tell or you maybe put it in the chat. You can email us, you can call us. We'll still be in touch over the course of time with, and hopefully have more time with some SBA folks to be able to get some questions answered. So if you have specific questions, if we can't answer it, hopefully we can get you an answer. You can just reach out to us in just a second. You're going to see our regular email address for the general email for our office is right here, sbdc@uark. My email is mebrooks@uark.edu. That's M as in Mary, E as in Elizabeth, Brooks, BROOKS @uark.edu. And Scott, what is your email?
SL072@uark.edu.
Okay, and just a reminder to post in the Q&A or the chat if you have a question. We still have a few more minutes that we could answer questions. This PowerPoint will be sent to everybody who registered for the webinar, so you will receive that. And then, of course, Mary Beth, the big question is, when is it going to open and how will they find out?
I would be religiously checking the SBA website, and we'll reach out to our clients. We always are keeping all of our clients really posted, and as it gets closer and closer, we'll continue to do so. And if there's a need and we have a lot of questions, Scott, we can, don't you like how I volunteer us? We could either do a quick Q&A, over a lunch kind of time, or we'll host another one of these, whatever the demand is, we'll be happy to do.
And remember, it's really easy to become a client. Just go to our website and up on the right-hand corner, click Get Consultation. So very easy. I'm not seeing any more in the Q&A or the chat. So I just want to thank you again for being here today. Again, you will be emailed a copy of this presentation and a brief survey. We appreciate you giving us feedback via the survey. Don't forget to visit our website. It's in the chat at sbtdc.uark.edu to get this recording, to sign up for consultation, past presentations, future programs, and much more. You can also just simply use the QR code that you see on the screen there to get to the site. And with that, please stay in touch. We are posting all of this on social media, so you can follow us on Facebook, Instagram, and LinkedIn. And we will continue to keep you updated on the RRF, and we will see you next time. Thanks, everyone.